Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The appetite for risk across the Asia Pacific has been reduced somewhat by a spike in trade tensions between the U.S. and Europe. We're seeing equity markets in Tokyo, Sydney, and Seoul in retreat. Now, Europe's willingness to resist President Trump's demands when it comes to Greenland seems to have raised the stakes noticeably, and many markets now are pricing in the case that this confrontation could escalate. For a closer look at what we're seeing in markets, let's bring in Bloomberg's Winnie Hsu. Winnie is our Asia equities reporter. She joins us from our studios in Hong Kong. Thank you for being here. So aside from the U.S.-Europe trade story, we had a couple of key data points for China that were released on Monday. And if you don't mind, I'd like to start here. The GDP number for the fourth quarter, an annual growth rate of 4.5%. And that means that China was successful in achieving its annual growth target of 5% for all of last year. Am I right?
Yeah, so actually, like you mentioned, they were able to meet that 5% target. We thought that tariff was going to be a big headwind for China, but actually it turns out that not so much. It does have a lot of strength when it comes to the manufacturing capabilities, and that's why, we saw that they were able to meet that target. But I think the highlight this time around the numbers were what you mentioned around the fourth quarter numbers. Yes, it did come as expected, 4.5%, but that was actually the slowest since 2022, since the end of COVID. I think the interesting part is that the fourth quarter numbers, it did come as expected when it comes to the 4.5% growth year over year, but that was actually the slowest growth since late 2022. And the combination of the softer retail numbers, which came slightly below estimate, and then the stronger than expected industrial output numbers, that combination really goes to show how China still have a big imbalance problem when it comes to stronger manufacturing capabilities versus very weak domestic demand. So all that data together goes to show that. And this time around, that has more implication for equity investors because they're seeing the divergence in the economic data to signal potentially a divergence in the China story. And, investors telling us that this might signal the two Chinas that they need to kind of balance when it comes to how they invest in the equity space as well.
So the retail sales data and the industrial production data were part of the monthly activity data for December. And also we learned that fixed asset investment was down at a rate of about 3.8% from last year. And my sense is that that is probably the more worrisome development, right?
So you can see it from two sides of the equation. The 3.8% decline, like you mentioned, why it was worrisome is because it was the first time we saw an annual decline in that number in the past maybe over 3 decades or so. But part of the other equation is that because of this push for anti-involution, that we have so much excess capacity this time around that when the companies and factories were able to cut down on those investments, that's actually part of the government's effort to push for that. So yes, the investment side is slightly weaker, but it is part of kind of curbing the excess capacity.
So the issue with the property market was also front and center yesterday with the data on new home prices for December. Both new homes and existing home prices were down month on month. When is this going to turn around? Is there any sense that the property market is in the process, at least, of putting in a bottom?
Well, that the property crisis is still that problem that has been dragging on the Chinese economy for a long time. And like you mentioned, I think what we've been hearing and seeing so far is that although we're not seeing further decline, the decline rate is slightly slower and it seems to be bottoming already, but it's just showing very little sign of recovery from now. So we don't know at what point it's really going to turn around and at what pace it's going to turn around. But it's just the good side of it is that ideally this is pretty much putting a floor to kind of the property crisis from going further down. But because the property crisis is still a drag on the economy, that's why even though people are talking about how this new 5-year plan is going to be focusing a lot on boosting domestic demand, until we see a turnaround in the property situation, that's going to still keep foreign investors specifically from pouring more money into the Chinese market. And that's a key concern that they've been flagging.
Can we talk about Japan for a moment? Because we learned officially now that Prime Minister Takaichi has called for an early election. It'll happen next month. And at the same time, I think she's promising a temporary sales tax cut on food if she wins her fresh mandate and kind of creates maybe a more robust coalition. Are people feeling that we're likely to get more stimulus out of Japan as a result of this?
Yeah, exactly. And that's why we're seeing how markets have been moving in the past few sessions cross-asset wise. And that's specifically clear when it comes to the bonds space. We're talking about 10-year yield, 20-year yield hitting fresh highs or hitting its highest levels since 1999-ish. And that's because of, as you mentioned, expectation for stimulus, which means bigger fiscal budget. And that's why it's hurting the bond space. And also the yen has been weakening. But when it comes to the stock side, we're also seeing that expectation playing out, right? Because topics, Nikkei, they have been hitting these record highs on those expectations. Yes, recently in the past few sessions, a bit weaker on that global geopolitical risk. So overall, a bit of a risk-off mood. But when you look at sectors specifically, yesterday or even today, right now, we're seeing very strong performance when it comes to the food sector. We're talking about supermarket chains, retails, and these sectors that would really be benefiting from Takaichi's further stimulus and that cut when it comes to the food tax. So it seems like markets are taking that in and pricing that in right now.
So it's interesting that you mentioned the weakness in the Japanese currency. I saw a note today from analysts over at Citigroup in Tokyo, and they were saying that the Bank of Japan will probably raise interest rates 3 times this year, double the current level. I think we're at 75 basis points on the policy rate right now. That would be the case if, that's the caveat, the yen continues to weaken. Now, we have a BOJ decision on Friday. Any chance that we're going to get a rate hike this time around?
Well, that note seems to be quite an interesting forecast there because actually, at least for the upcoming one this week, for the economists we've surveyed, all of them are saying that the Bank of Japan will likely keep the rates steady, especially just because we just had a rate hike in the previous meeting. So the Bank of Japan is likely going to take a more cautious stance and take it slow as they kind of look at the economic data and look at kind of the uncertainties around the political front. But like you mentioned, for them, two things that they're very concerned. One is around kind of the weakness around the Japanese yen. So that's why Governor Ueda is likely going to be very careful with his wording so that he doesn't cause a sudden weakness or a sell-off in the currency. But at the same time, inflation has been something that they're closely watching, right? We just talked about that tax cut around food. Why is that? That's because food cost has been the biggest part that's been driving Japan's recent inflation. Inflation right now is above the 2% target that the Bank of Japan has set. And that's why we do have more expectation for rate hikes to come in the next few decision meetings to come, but unlikely in this upcoming one.
We'll leave it there. Thank you so very much for joining us. It's very much always a pleasure with Winnie Hsu, Asia Equities reporter, joining from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. In South Korea, the benchmark Kospi is down today after a 12-day winning streak. Chip makers are leading this decline given some trade tensions between the U.S. and Europe. Samsung and SK Hynix are down, as are shares in Hyundai Motor. But despite the pullback, there seems to be a little bit of underlying optimism. We had the chance to catch up with Jeong Eun Bo, the CEO of Korea Exchange. Po spoke through an interpreter to Bloomberg's Youkyung Lee, and the discussion began with Chung talking about his outlook for South Korean equities.
I think the Kospi can extend beyond 5,000 and towards 6,000. Since the year before last, we have made efforts to increase shareholder returns through various programs, which have been supported by the government through policies and legislative revisions. Recently, South Korea's main industries, such as chip, defense, and shipbuilding, have been more competitive, which appears to have led to a new value up for the Korean stock market. It's nearing 5,000, but I think beyond that, even 6,000 is possible.
Now let's talk about trading hour extension. So Korea Exchange said this week that it's going to extend trading hours to 24 starting the end of 2027, and it's going to introduce 12-hour trading starting this June. Why does Korea Exchange have to pursue this extension of trading hours?
In light of these global trends and also to attract foreign investors, I believe expanding trading hours is inevitable. While monitoring the transition to 24-hour trading in the US this year, we believe we should move to a 24-hour trading system ourselves by at least the end of next year. Doing so would help attract overseas investors and ensure greater alignment with global market standards. As a transition, we plan to start 12-hour trading from June.
The won's weakness has been a big concern for South Korean authority, and once South Korean stock become a lot more attractive than now and have retail investors come back to the domestic market, do you think that can help stop won's weakness?
I think it would absolutely help. From a macroeconomic perspective, despite Korea running a sizable current account surplus, I believe the fundamental reason the won continues to weaken lies in the capital account. The first factor is the outflow of foreign currency driven by corporate overseas investment. The second is capital outflows stemming from domestic investors' investments in overseas assets. Together, these flows have been a key driver of the weakness in the won. In that context, the impact of portfolio investment on the exchange rate, often exemplified by so-called global ant investors, could begin to normalize as domestic investors return to the local market, and more importantly, as foreign investors increase their investments in Korea. I believe that process could serve as a catalyst for stabilizing the currency exchange rate.
When you said a few years, South Korea will be able to get an upgrade to the DM index with the MSCI, and how soon, a few years, do you mean?
The president aims to join the Developed Market League within his tenure, so that appears to be the final target that South Korea should pursue. It might take a few years, as it takes 1 or 2 years before the final reclassification is determined after joining the watch list first. Even if we start the process right now, the procedure will take several years.
And there are also concerns that the upgrade to the DM index would actually trigger funds outflows. What's your thoughts about these concerns that the upgrade may not be necessarily a good thing for the South Korean stock market?
Fundamentally, global capital is far larger than domestic capital. It's so large, the two are hardly comparable. If Korea is reclassified from an emerging market to a developed market, there will be mandatory allocation requirements for global capital. Therefore, I believe the inflow of capital will be substantially greater than the outflow.
Let's talk about some of the issues related to Korea discount. So one of the priorities that the Korea Exchange have is delisting the so-called zombie firms in market and accelerating the delisting process. Why is this important to resolve Korea discount?
About 2,800 companies are listed in South Korea. In the US, about 5,500 companies are listed on the New York Stock Exchange and the Nasdaq. The US GDP is about 15 times bigger than South Korea, while the market capitalization is 30 times larger. But the number of listed firms is only 2 times bigger. If you do the math, the market cap of individual firms in South Korea is about 1/15. In that sense, we think too many companies are listed in South Korea. In the future, these zombie firms must be forced out quickly to restore market trust. These unprofitable companies are easy targets of stock price manipulations and other unfair trades. To enhance confidence in our domestic stock market, we should do speedy work on rooting out zombie firms.
That is Jeong Eun Bo, the CEO of the Korea Exchange, speaking to Bloomberg's Youkyung Lee here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.